GameStop should have issued stock. Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Twitter.com/StockerFinance for more. Also, subscribe to the newsletter. Going to be a monthly newsletter. Definitely check out the link in the description below. So, GameStop currently went through a wild ride, to say the least. It got pumped up to around $480 a share due to one of the craziest short squeezes I've ever seen in my lifetime. Currently, it's trading at just around $60 a share. Now, the market cap is $4.45 billion, has a dividend yield of 2.38%. 52-week high of 483, but a 52-week low of $2.57 was just one of the craziest rides for a 52-week high and low. That separation there is just incredible. Now, let's get back to the main topic of this video of what does it mean when a company issues new shares. So when a company issues new stock, it's usually in a positive light to raise money for expansion, buying out a competitor, or the introduction of a new product. Current shareholders sometimes get angry and they view dilution as a negative because they're issuing more shares. That means they're going to have less voting power. With GameStop, they should have done this, though. I mean, if we look at their shares outstanding here, it's 69.7 million shares outstanding, an average volume of around 30 million, with the float of 46.89 million. And if GameStop had issued shares at the peak price, let's say they just issued 2 million shares, well, that's roughly about 2% dilution there. That means they raise at $400. Let's just take a $400 a share price tag there. They could raise roughly $800 million. Obviously, they didn't do that. Let's say they did it to 1 million shares at $100 a share. They could have raised $200 million. How about a million shares at $60 a share? The current price, we're going to cut the amount of shares they're issuing in half. $60 million. A million shares at $50 a share, that's $10 less than what this stock is currently trading at. They could raise $50 million, which would drastically help the company and potentially turn them around. But they did not do that. Now, what if they did? What should they use the capital for? But let's say let's use the conservative number of $60 million. So right now they issue a million shares at $60 a share, which they probably could still do right now, depending on how much demand for their stock there is still. But they raised $60 million. Well, what could they do? In my opinion, they should purchase video game developers or multiple for $25 to $30 million. So some small video game developers. They could use some leverage as well if they really need, although their debt is not in the best situation. So I would really rather have GameStop not acquire more debt or have to deal with that situation. Let's say they buy it cash, $25 to $30 million. They still have $30 million left over. They now owe some video game developers. They produce the games. So development costs, let's say that cost another $20 million. Now they have $10 million left over. All right, that leaves you with $5 million for advertising, partnerships, brand awareness. You can definitely market a game very well with $5 million, and you still have $5 million left over for wiggle room. That's an incredible strategy that can completely turn the company around, but they have not done that, and it doesn't look like they're planning on raising this money whatsoever. So to me, this is completely a sign of poor leadership in the company. And they're experiencing declining sales. They're losing money every quarter. On top of that, they have lots of bad debt. Their liabilities are increasing faster than their total assets. As you can see here, it's declining really rapidly, down to $612 million as of 2020. Shareholders' equity continuing to decline, and the quarterly growth for that decline is only increasing. It was negative 46% back in August that quarter. On top of that, their margins are worsening. We're seeing gross margin decline. We're still seeing operating margin and net margin not in the best places, although they have started to turn around a little bit. I will give them that. If we look at their net current asset value per share value, if we take the total shares and the total shareholders' equity, which is total assets minus total liabilities, and we then divide that shareholders' equity by the number of total shares, that's 69,750,000, and you get $4.76 a share. Now, the current share price is $60. That's significantly greater than their liquidation value or their net current asset value per share value. That's not a good sign for GameStop either. GameStop's also closing 1,000 more stores by April, as I've stated in previous videos. And yes, this will help them cut costs. They might make some more money because of this. And perhaps they can make some executive decisions and try to turn the company around with the money that they're going to save from these most likely money-losing stores. Well, in the long term, I think this will actually end up hurting them significantly. They're going to lose a lot of stores. People are going digital. Video games are going digital. People no longer need to go into a store and purchase a game. Even, you don't need to purchase, unless you really want some specific used game, you're going to go into a GameStop. Otherwise, there's really not much of a need for that. All the consoles, the PS5, they have a version that doesn't even come with a CD player. You can buy it completely without that, digital only, and that's going to hurt GameStop. So is GameStop overvalued? I've stated it before. I'll state it again. Even at this price, fundamentally, money? Yes, it is. If they had issued more shares, though, they could have completely turned around the company, and I actually would have considered investing in GameStop if they had issued more shares. I think it would have been a very great strategic decision for them. Shows that they have good leadership to make that executive decision, and they could potentially purchase video game developers. They could use their stores as a distribution network. They could help pay off their bad debt to turn around their shareholders' equity, which is currently declining. They could also increase the sales and marketing budget to hopefully increase their sales and turn that trend around as well. Anyways, thanks for watching. Please subscribe. Check out these videos, twitter.com/StockerFinance for more. Definitely go check out my some funny commentary over on Twitter, and subscribe to the newsletter below. You're definitely going to want to do that. It's only a once-a-month email that does full market condition reports, stock analysis, etc. Anyways, guys, I'll see you in the next video. Peace out.